Hello everyone, welcome back. Today we are doing another single company presentation, and this time we're talking about Arthur J. Gallagher. This is a fascinating company, and we recently added it to our Zacks Earnings Certain Proxy portfolio just a few months back, and wanted to give an intro on this very important company that you may not ever have even heard of. But Arthur J. Gallagher is a behemoth in global insurance. So let's talk a little bit about who they are, what they do, and why we have added it to our conviction long-term, high-quality portfolio that is the Zacks Earnings Certain Proxy. So let's get started on talking about that. So just a quick overview. This is a company that's now almost 100 years old. They're going to be approaching their centenary in 2027. They were founded in 1927 by the original Arthur J. Gallagher, and it's actually been an interesting succession within the family. So the CEO today is Pat Gallagher, and that's the company was founded by his grandfather, who was the original Arthur J. Gallagher. And it's now grown into one of the largest global insurance brokerage and risk management consulting firms in the world. So it's important to understand what they do. They work in the insurance industry, but they don't directly compete with the household insurance names that you're familiar with, like Allstate or Progressive, things like that, because they're not a underwriter. Those are underwriters like Allstate and others. Arthur J. Gallagher is instead an insurance broker, and they also provide risk management services. So they have, two primary reportable business segments: the insurance brokerage segment and the risk management segment. And some of their key competitors, you might have heard of them: Willis Towers Watson, Aon. They are also similarly a insurance brokerage firm, which also provides consulting services. But Arthur Gallagher is huge. They do employ over 50,000 employees. They're present in over 130 countries. They have 460 sales and service offices throughout the U.S. and another 300 offices throughout the world, primarily in these four countries: the UK, Australia, New Zealand, and Canada. And as of 2022, they had $10 billion of revenue. And another thing that's really interesting about this company, which you don't often see, is that they are a serial acquirer. This is something very important as a part of their overall corporate culture. They've made over 650 acquisitions since 2002. These are mostly small deals, but still, it's an interesting way that they have structured their business. So they've grown both organically, but also they've grown additionally through acquisitions. And remember, an important thing about being a serial acquirer is that you end up building up a lot of goodwill on the balance sheet, and that ends up leading to all sorts of accounting issues. It also leads to suboptimal returns on investment. And so we'll take a look at exactly why we think this is a serial acquirer that does add value, as opposed to many acquirers who end up destroying value, because they pay very large premiums, also known as goodwill, and therefore they grow, but they don't earn attractive returns on invested capital. So a lot of companies, they can juice growth through acquisitions, but if they don't earn attractive returns on those investments, then it actually ends up being a value destructive operation. But we'll take a look at exactly why I think it's actually a value additive strategy that they've been able to pull off. These deals range from 1 million to 100 million. They primarily target small insurance brokers, so basically right up their alley. They look for vertical integration, within their key areas of expertise. So small insurance brokers as well as benefit consulting firms. Here's a breakdown of their two core segments. They have the brokerage segment. This is their major source of revenue. That's 87% of revenue. So they advise and consult on insurance programs and place insurance for clients. They mostly deal with property and casualty insurance as well as employee benefits and managing that. Remember, they represent their clients, and their clients are mostly Fortune 1000 firms. So they help their clients, reduce or eliminate, in many cases, losses that come from, adverse events in the property casualty market, as well as on the risk management side. They primarily deal with workers' comp. So they help their clients minimize losses due to workers' compensation claims. So that is 13% of the revenue from the risk management side, but the lion's share of revenue comes from that brokerage segment, the insurance brokerage industry area. So why do clients come to Gallagher? They come to them for advice on crafting and purchasing custom-tailored property casualty insurance policies. That's their brokerage segment. And they help clients minimize workers' compensation losses. So that's the risk management segment. So it's almost like, if you are, an investment advisor, if you're a financial advisor, why do clients come to you? They come to you for advice on crafting and purchasing the right investments for them, which is customs tailored based on their ability to take risk, willingness to take risk, and other factors that, affect, tailoring a investment program for a client. So in the same way, clients come to them for advice on, using their expertise in the global insurance industry, because they also do a lot of really niche work too. They often place insurance that isn't very frequently purchased. There's insurance that is, widely known, but then there's also insurance for very, very rare situations that certain clients have exposure to. So they come to an expert like Arthur J. Gallagher to help them identify the right insurance policy for them, and then ultimately to purchase that insurance policy. That's the brokerage side, and that's where they earn both flat fees as well as commissions. And then of course other clients, maybe that's those same clients, come to Gallagher for help with their workers' compensation policies. Here's a little bit about the acquisition, aspect. So, as you can see here, every single year, they've made, significant acquisitions, and it's kind of grown over time. As you can see, 2021 was a banner year. They spent, almost $1 billion in acquisitions that year. It's since slowed down a little bit, but still high relative to, just about 10 to 15 years ago. So this is a company that is, growing both organically, but also through acquisitions. So here's the reason why we added it to the portfolio. Remember, the Zacks Earnings Certain Proxy looks for companies that are the highest quality caliber companies among the large cap space. So we look for companies with business durability and high quality. And you'll see exactly why we think Gallagher has, both of those sides. So with business durability, we look at linearity. We look at earnings linearity over time. And the earnings linearity over time has been 0.92. That's 92% R squared. That is a very high number with out of a possible, max score of 1. 0.92 means that they have virtually linear earnings growth, which, basically goes to show how durable the business is and how predictable the cash flows are over time. Similarly, the free cash flow linearity is very high as well at 0.81. Typically we like to focus on companies that have at least 0.8 or higher, but most companies have 0.9 or higher in practicality. So we have, both, criteria met here between earnings and free cash flow. They also have growth. So we will look for linearity that tells you business durability. But sometimes durability could mean very, very slow growth, right? It could be, tobacco, for example. They have very durable, they have a very durable business model, but they have very slow growth at the same time. But they've got growth as well here with earnings CAGR over the past 10 years of 15%. 10-year free cash flow CAGR of 20%, very, very strong compound growth. And then we look at return on invested capital. This is especially important for an acquirer like Arthur J. Gallagher. So we want to know what returns are they generating on the capital that they deploy. Because remember, growth can be very strong, like you see here, 15%. That could enamor a lot of growth investors. But what if your returns on capital were, below the cost of capital? What if they were 5 or 6%? What if they were 4 or 3%? Well, then suddenly that growth is not very attractive at all because it's very expensive to generate that growth. It means that the company has to deploy lots and lots of capital to generate that growth, which would then mean that they have very little excess free cash flow at the end of the day. So companies that don't have very strong, returns on invested capital are then punished by the market with low multiples, even if they have higher growth. So this happens, occasionally throughout the markets where you have growth because of acquisitions, but the market, punishes the stock price because management is kind of reckless with the acquisitions that they're making. Even if it generates growth, the returns on capital may not be as strong, especially if the companies that they're acquiring are public companies. But even if they're private, it doesn't add value to investors in the public space if Arthur J. Gallagher is not generating value out of those acquisitions, meaning better margins post-acquisition or strong returns on invested capital well above the cost of capital. So in this case, the ROIC is strong at 11.2%. I would typically like it to be a little bit higher than that, but anything above the cost of capital, you can use any kind of model to understand what that should be, like the CAPM model, for example. If you take the risk-free rate plus the equity beta times the equity risk premium, that gives you a cost of capital or a cost of equity of around 8% for most companies. So anything above 8% in terms of ROIC generated means that the company is indeed adding value. And so that's what we see here. And I'm going to show you a chart real quick in the coming slides as to what that looks like over time. But you can see here the 10-year median has been 8.6%. So they've actually grown, increased their ROIC versus the 10-year median. So the current value is, significantly better than the median value over the past 10 years. And then the last metric, which is probably, just as equally important as the other three, which is free cash flow conversion. This is a very important metric for assessing quality. Because remember, companies can generate and show strong earnings, but if they're not able to translate that into free cash flow, then those earnings are questionable at best. So I like to look at free cash flow conversion. This is basically the ratio of free cash flow to net income. And right now it's phenomenal at 126%. So that's great currently, but what about over time? You want this number to be, well in excess of 80% at the minimum. Sometimes they make exceptions to that. Sometimes we go down to 70% in certain cases, but on a median basis, we want that number to be well above 80%. And here we have a 10-year median of 125%. So this is a free cash flow printer. This is a phenomenal business with, again, very strong business durability, which is the linearity, very strong growth, both organic and through acquisitions, strong returns on invested capital that adds value to public shareholders. And then again, very high quality, which is that they're able to translate, 126% of their earnings into free cash flow. So this is the 4 planks of quality, and it checks off on all 4 of them. This is what we look for when assembling the Earnings Certain Proxy portfolio. So here's a look at their linearity. You can see how linear their earnings have been over time. You can see the slope of that has been about 15%. That is the 10-year earnings growth of Arthur J. Gallagher. Here's a chart of their return on invested capital. You can see very strong. Sometimes it has kind of cycled down a little bit here, down to 8%. That's kind of my threshold. I don't like to, invest in companies below 8%. unless if there's a very strong reason for that. But now since then, they've made significant strides in generating excess returns on invested capital after the acquisitions that they've made are starting to bear its fruit. And so you can see that, again, as long as a company has generates ROIC well in excess of the cost of equity, then this is a company that's adding value through whatever means that they are doing, whether it's acquisitions or whether it's organic growth by reinvesting back into the same business. The ROIC tells you exactly that. Here's a chart of the invested capital. So this is the denominator of ROIC. In the numerator, we have net operating profit after tax. So that's that's basically net income plus interest expense. That's basically the numerator. And the denominator is invested capital. So that's basically your long-term fixed assets plus net working capital. So that's your current assets minus non-interest-bearing current liabilities. So this tells you exactly how much is the company reinvesting for growth. So you can see very strong growth. Part of the equation here is goodwill, because remember, goodwill does get captured in long-term fixed investments. So that is being reflected here. So as they make acquisitions, no matter the size of the acquisition, it gets reflected in this number here. So remember, as the denominator increases, it makes it harder for them to show strong ROIC, unless if they are experiencing commensurate earnings growth at the same time or net operating profit growth at the same time. So despite the fact that, they've reinvested strongly for growth, you can see again that the ROIC, which is the ratio of net operating profit to invested capital, has been strong and has actually been increasing. So that means that earnings have been growing even faster than the rate at which they are deploying capital, back into the business as well as into acquisitions. So that is exactly what we like to see. Expanding ROIC tells you that there is value creation happening. And here's a chart of their free cash flow conversion. As I mentioned, very, very strong quality, operation where they have consistently over time been able to translate more than 100% of their net income into free cash flow. So that's very important because at the end of the day, free cash flow is what matters to investors because that's the cash left over, in the business for the company to then do things like dividends and acquisitions as well as share buybacks. So hopefully you found this helpful. Again, I'd love to hear from you if you have any questions or any other concerns, or if you'd like to see a topic or a company that you want me to dive into in one of these presentations again in the future. Please do reach out. I'd love to hear from you. You can reach us at 1-866-794-6065, or you can send us an email to strategycall@zackspro.com. All right, thanks everyone. Take care. Have a good one.